All right, so Seema, we saw investors, they didn't seem to pay a lot of attention to the president's talk about tariffs. Big shock to the market. Now we see the president and the Treasury Secretary talking about the 10-year and trying to move those rates a bit lower. Should investors be thinking about that and positioning around that push by the president and the Treasury Secretary? I'm thinking about rate-sensitive sectors like financials and small caps. Do you need to make some moves in those areas based on these comments?
So I think investors do need to, of course, listen to what is being said by the administration to understand some of their thinking. And certainly what a lot of what was said about, maybe hopefully if deregulation, reducing the deficit would push down bond yields, that would be a positive. Of course, saying that and then offsetting that with tariffs, immigration, which are two policies which are typically inflationary, is probably a different question. So I think it makes sense, but the market is going to move in response to actual policy actions. If we do start to see those tariffs actually coming through, we should expect inflation, at least in the near term, to start rising, and there would inevitably be some kind of impact on bond yields.
I want to get back to those trade policies. Tariffs, they do seem to be kind of shaking the confidence of business leaders to make decisions, a lot of uncertainty about what's to come. When it comes to big tech, I also want to ask you, are these tariffs and some of these other just actions that are creating some volatility, do you think it's shaking investor confidence in aggressive CapEx spending? I mean, we saw Alphabet hit for that. We have Amazon coming up after the bell. Do you believe when it comes to tech overall, are investors becoming more skeptical about those plans?
Well, I think with regards to CapEx, firstly, one of the things that we did learn from Trump 1.0 is just the threat of tariffs, even then when they were actually significantly smaller than what we're potentially facing today. There wasn't an immediate knock-on impact to global CapEx plans. That kind of uncertainty really does weigh on business confidence, and it does stop businesses from moving forward with some of the projects that may have been planning. So that's worth keeping in mind. Specifically for technology, it is being impacted by a number of different factors. You just have to think about DeepSeek last week, tariffs with which technology would likely fall into some of those crosshairs. So I think there are question marks for investors. But I think overall, the long-term outlook for technology is still quite positive from our perspective. It's just that right now, when you do have solid growth like we have today, and earnings growth is looking fairly positive, there are opportunities in other sectors which are probably not as stretched in terms of valuations. And so there are opportunities outside of technology as well.
All right, I want to focus again on the U.S. You say the labor market's in what you call an uneasy equilibrium. What exactly does that mean, and how could this jobs report coming up this week, how could that impact the markets in your mind?
Yeah, so what we've seen in the U.S. is there's not really much firing. We've seen a very limited number of job cuts being announced, and you can see that from jobless claims staying very low. But at the same time, we're not really seeing many companies increase their hiring. So it's this uneasy equilibrium where the labor market is essentially frozen, not many hirings, but also not many firings. That is okay for now, but that equilibrium doesn't typically last for too long. So if you were to see labor demand start to tail off at any point, that could quickly spiral into a slightly more negative scenario. So for the payroll report tomorrow, what we're expecting to see is another month of solid payrolls. But as we start to go through the rest of the year, if you were to see payroll numbers start to drop off, that would suggest that uneasy equilibrium is now shifting into something more negative. Easily, though, you could see that if some of the policies start to work out better, deregulation coming through, you could actually see the labor market reheating. Unfortunately, the offset of that could be higher inflation.